The persistent influence of monetary policy continues to shape market expectations. The Federal Reserve's recent decision to maintain its current stance on interest rates, as widely anticipated, continues to reverberate through various asset classes. While the absence of a rate cut wasn't a shock, the accompanying commentary and forward guidance are what truly matter. The market is constantly trying to decipher the Fed's commitment to its data-dependent approach and the timeline for any potential shifts. This patient stance signals that the central bank remains vigilant against inflationary pressures, even as it monitors economic growth. For investors, this translates into an environment where higher for longer remains a tangible possibility, impacting everything from borrowing costs for corporations to the attractiveness of different asset classes. This cautious posture from the Fed implies that we are navigating a period where monetary policy will continue to be a significant driver of market sentiment, demanding close attention to every data point and every public statement. Turning our attention to the bedrock of financial markets, the bond market offered some interesting signals today. We observed a slight dip in the yield of the benchmark 10-year Treasury note. This movement, while subtle, is indicative of a market potentially recalibrating its expectations. A falling yield can often suggest a flight to quality, as investors seek the relative safety of government bonds amidst broader market uncertainty, or it might reflect a revised outlook on future economic growth and inflation. Furthermore, the bond market's behavior has direct and immediate implications for everyday financial decisions. The constant interplay between Treasury yields and mortgage rates, for instance, means that the Fed's consistent stance, coupled with these bond market dynamics, continues to influence the cost of home ownership and refinancing opportunities for millions. The decisions made in the serene halls of central banks and the bustling trading floors of the bond market directly trickle down to the financial realities faced by households across the nation. Beyond the domestic sphere, the actions and inactions of central banks globally are creating a tapestry of diverging monetary policies. While the Federal Reserve stands firm, other central banks around the world might be contemplating different paths, driven by their unique economic circumstances. This divergence has a profound impact on currency markets. Today, we saw the euro soften against a strengthening US dollar. This dynamic is often fueled by perceptions of interest rate differentials and economic growth prospects between regions. A stronger dollar can have far-reaching implications, making US exports more expensive, but potentially lowering the cost of imports for American consumers. It also plays a critical role in the pricing of global commodities, which are often denominated in dollars. Therefore, the coordinated yet sometimes contrasting moves of these powerful institutions create a complex global financial environment, constantly shifting the balance of power and influencing trade flows and investment decisions worldwide. Today, the commodity markets experienced significant turbulence, particularly impacting gold and the energy complex. Gold, often seen as a safe haven asset and an inflation hedge, took a substantial hit, retreating sharply from its recent highs. This dramatic move suggests a potential shift in investor sentiment, perhaps indicating a renewed risk-on appetite in other areas of the market, a strengthening dollar making gold more expensive for international buyers, or simply a period of profit-taking after a strong run. It raises questions about the market's current assessment of future inflation risks and the perceived need for traditional safe havens. Meanwhile, the energy sector also saw a broad-based decline, with crude oil benchmarks pulling back along with natural gas prices. This softening across the energy complex could be attributed to a confluence of factors: evolving global demand forecasts, an improving supply outlook, or even subtle shifts in geopolitical tensions that alleviate some of the premium built into prices. For consumers, a dip in oil and gas prices is generally welcome news, potentially easing inflationary pressures at the pump and in heating bills. However, for energy-producing nations and companies, sustained weakness could impact revenues and future investment. The movements in these vital raw materials are not just about supply and demand. They are a powerful barometer of global economic health and geopolitical stability, reflecting the intricate connections within our interdependent world. Today's market was a striking illustration of divergence within specific sectors, particularly among the technology giants. We witnessed a tale of two titans, one soaring to new heights, the other facing a significant re-evaluation from investors. Meta Platforms delivered a truly stellar performance, rallying strongly on what appears to be exceptionally positive news, likely a robust earnings report or an optimistic outlook that has reinvigorated investor confidence in its advertising revenue streams and future growth initiatives. This demonstrates the market's willingness to handsomely reward companies that exceed expectations and paint a compelling vision for the future. In stark contrast, Microsoft experienced a notable decline, signaling that even the most dominant players are subject to intense scrutiny. This substantial move could be attributed to a miss on earnings, a cautious outlook provided by management, or concerns about competition in key business segments like cloud computing or software services. It serves as a potent reminder that even market leaders are not immune to investor skepticism if their performance or guidance doesn't align with lofty expectations. Other major tech players like Nvidia, Apple, and Alphabet showed resilience with modest gains, while Tesla and Amazon faced downward pressure, illustrating a highly selective environment where individual company fundamentals, rather than a broad sector trend, are driving investment decisions. Beyond tech, the financial sector showed encouraging signs of strength, suggesting optimism about the economic outlook or the benefit of sustained interest rates. Similarly, the energy sector demonstrated resilience, with many companies holding steady or even advancing, despite the broader dip in commodity prices, indicating a belief in the long-term value proposition of these firms or the strength of their balance sheets. The digital asset space experienced a notable retreat today, with both Bitcoin and Ethereum undergoing significant downward pressure. This cooling across the broader cryptocurrency market often reflects shifts in global risk appetite, regulatory concerns, or simply a period of profit-taking after previous strong rallies. However, the most compelling story in this space today comes from the corporate adoption front, specifically with MicroStrategy. This company, known for its aggressive strategy of accumulating Bitcoin for its corporate treasury, faced a substantial sell-off in its stock. The close correlation between MicroStrategy's share price and the underlying movements of Bitcoin highlights both the opportunity and the inherent volatility of such a strategy. When Bitcoin faces downward pressure, companies heavily invested in it, like MicroStrategy, can see amplified declines in their equity valuations. This serves as a critical case study for other corporations considering integrating digital assets into their balance sheets, illustrating the significant leverage and risk profile that comes with such exposure. The market is clearly re-evaluating the premium it places on corporate Bitcoin holdings in light of this volatility, prompting a deeper look into the implications of intertwining traditional corporate finance with the nascent, often unpredictable, world of cryptocurrencies. As we look forward to the next trading session, market participants will be keenly watching for several catalysts that could shape sentiment. While specific economic data releases are always on the radar, the ongoing narrative around inflation, labor markets, and consumer spending will remain paramount. Any unexpected shifts in these indicators could prompt a swift market reaction. Earnings season continues, and individual company reports, particularly from sectors that have shown volatility today, will be critical in shaping sector-specific movements. Geopolitical developments, especially those impacting global trade or commodity supply chains, also hold the potential to introduce fresh uncertainty or provide new opportunities. Investors will be dissecting every piece of information, looking for clues to the Federal Reserve's next move and the broader trajectory of the global economy.